About 15 years ago, my father traded commodities at night using a phone just like this, just raw numbers blinking on this exact screen. He didn't have access to charts, trends, or any visual data. In a single night, trading blindly, he lost 10 lakhs. Today, we have modern candlestick charts that visualize every fraction of price movement. But if you try to use these tools without proper education, the market acts as a two-edged sword. You will bleed your own capital first. We are going to fix that right now. By the end of this video, you will understand how market prices are actually negotiated, how to avoid the hidden traps that cost beginners thousands of rupees, and exactly how to set up your own fee-free trading account. Committing to learn the mechanics of the market before you place a single trade is the only proven method to protect your hard-earned money from disappearing overnight. Let's start at the source. For any company to scale its operations, it requires a massive influx of capital. Instead of taking on crushing bank debt, a company can choose to sell portions of its ownership to the public. The very first time a company offers these shares to the public in exchange for capital, it's called an IPO, or initial public offering. When this works perfectly, the results are highly lucrative. For example, when Tata Technologies recently launched their IPO, early investors secured a massive 50% listing gain the moment those shares hit the open market. But IPOs are not guaranteed paydays. When Paytm launched its IPO, the market rejected its valuation. Shares immediately traded at a 30% discount, handing heavy losses to anyone who bought in blindly. Once that initial IPO phase ends, those shares have to go somewhere to be bought and sold by everyday traders. They go to a centralized exchange. In India, the two primary arenas that match millions of buyers and sellers every second are the National Stock Exchange and this building right here, the Bombay Stock Exchange, or BSE. Pause this video right now, open a new tab, and find out two things. Which of these two exchanges is older, and exactly how many companies are listed on each? Drop your findings in the comments below. Understanding exactly where shares originate and the physical infrastructure where they are traded is your first line of defense. It separates serious investors from people who treat the market like a casino. Once you are looking at a stock on the exchange, you enter the digital battleground known as the order book. This is where buyers and sellers state the exact non-negotiable prices they demand. Look at this order book visualization. The column labeled bid shows the absolute maximum price a buyer is currently willing to hand over for a share. In this example, our buyer is bidding exactly 1,000 rupees. Now check the ask column. This is the absolute minimum price a seller is willing to accept to part with their share. Here, the seller is asking for 1,005 rupees. The numerical difference between these two parties, this 5-point gap right here, is called the spread. This brings us to a crucial concept, liquidity. If the spread is incredibly tight, say only 10 paise instead of 5 rupees, it means buyers and sellers are highly active. That high liquidity creates a safe environment to trade. The danger arises when beginners ignore liquidity and blindly click buy or sell using a market order, which forces the trade to execute at whatever the next available price is. Recently, a trader was working with options on Havel stock. He had a winning position and wanted to secure his profit, so he executed a standard market order to close it out. But because that specific option had low liquidity and a massive spread, the market order forced him to sell at an 8 rupee discount per share. That invisible execution gap instantly turned his winning trade into a loss. Manually verifying the liquidity and checking the spread before you hit execute is your ultimate safety check. It completely prevents those invisible slippage losses from eating your capital. To actually access these exchanges, view the live order books, and execute trades safely, you need a specific tool, a demat account. But you have to be careful. Many traditional brokers charge annual maintenance charges, or AMCs. These recurring fees will quietly drain your capital while you are still learning the ropes. To avoid this, navigate to the description and pinned comment right below this video. You'll find direct links to secure a discount brokerage account with 0 annual maintenance charges. Setting up a fee-free account removes the ticking clock of maintenance costs. You can fund it when you're ready, take your time studying the charts, and learn without financial pressure. Step by step, you now know how to read spreads, verify liquidity, and open a protected, fee-free demat account. You have the exact tools required to buy and hold the best companies in the world. But here is the reality of my own portfolio. Despite teaching you these mechanics today, I currently hold exactly 0 individual stocks. Tracking 20 different companies, constantly rebalancing, and worrying about management changes takes too much time away from my actual business. Instead, I use a specific exchange-traded fund, or ETF, strategy. It allows for aggressive, exponential capital growth, completely stress-free. I am going to break down that exact ETF strategy in our next video. Hit the subscribe button and enable all notifications so you don't miss the exact framework I use for my own capital. Building true wealth requires patience and a strict adherence to the mechanics we covered today. Get your account set up, stay disciplined, and go self-made. Jai Hind.